Hi, this is Tom from Hedge Fund Tips. Welcome to our 7th episode of our weekly video cast on general stock market commentary and review. So this week we want to start with the subject of the week, which is the trade deal, the phase one trade deal that was finally agreed to yesterday. And at first blush, the market really didn't know how to interpret it. It was light on details. There was no John Hancock signature. And no one could really understand what was in it, but it was generally good news, although we've seen Charlie Brown take the football away many times. So I looked and got the details on the deal later last night, and there's substance to it. So I want to walk you through some of the details, and I think the market's going to digest this quite well when we reopen on Monday and Tuesday. But the key headline is that Beijing has agreed to import at least $200 billion in additional U.S. goods and services over the next 2 years, on top of the amount that it purchased in 2017. So what they did in 2017, the baseline was $130 billion in goods and $56 billion in services. So, $186 billion. You add $100 billion a year on top of that, round numbers, 40-50% increase each year moving forward is a big deal. That is a huge win. And President Trump didn't have to give up all the tariffs either. So we still have some leverage to see that they execute on their promises. We're suspending Sunday tariffs, which brings down a lot of fear and shows a way forward. And they're going to start on phase 2 right away. So the ag is going to be $32 billion over, 2 years. They're going to do another $16 billion. So it'll be $40 billion per year, plus they're committing to an additional $5 billion per year more. So you could basically be looking at $45 billion a year ag in the next per year for the next two things. So $32 billion more in farm products over the next 2 years, or about $16 billion a year, on top of the baseline of $24 billion from 2017. So you're doing 24 plus 16 is 40, plus potentially an additional 5. That's $45 billion a year for 2 years. And then there's undefined energy, manufactured goods, etc. But it will be included in the $200 billion of additional goods over the 2017 baseline. That is unbelievable for any business, any country, anything to increase your business by 40-50% overnight, just from having taken a serious stance. And for the Chinese, this is stuff that they need. So this is basically a win-win, but they're going to front load some of that and really help juice our economy and their economy. There were commitments made on intellectual property. We'll see the granularity behind that. My sense is that there's going to be more granularity in phase 2, but they did say that there were agreements to certain intellectual property protections here in phase 1. Ambassador Lighthizer stated that. So you can find this article on the website from Reuters. It was really nice to see the specificity of the deal terms. And this is not a nothing burger. This is a substantive phase 1 win that was inked on Friday, and the details came out, the clarity of the details came out after the close, and just very, very impressive. So the second thing I want to cover today is the earnings estimates. They held in strong this week. So for 2020 on the S&P 500, we're looking at $178.47, which is about a 9.7% earnings growth rate. The last time we had earnings growth in this range near double digits was 2016 to 2017, and the market rallied mid 30% from Q4 16 to Q1 2018. So that's very promising. And what's also interesting that I've been saying for weeks is that what no one is pricing in is with this deal done, now that it's done, I kept saying that, every day that goes by without it done, estimates can start to come down. But what no one's anticipating is if something is announced, and I didn't expect it to be as substantive as it was, the details that we just went over, that you could actually start to see estimates come up as you deliver that level of confidence to C-suites around the country. We could start to see greater confidence in investment, in hiring, and different things that we're going to discuss in our core article in just a minute. So that was really, really exciting to see. So next, so be open to the possibility that for the first time in a while, we start to see estimates improving versus coming down as we get closer to earnings season. And we did see a one-off on that even in Q4. For Q4 2019, last week the estimates were negative 1.5. This week they're negative 1.3. That's unusual. Usually in the weeks coming into earnings season, they're taking them down so that they can beat. And here they took them up a little bit. We'll see if that's an aberration, but that was certainly nice to see. And now that the deal is inked, are we going to start to see 2020 earnings in the next 4 to 6 to 8 weeks start to come up? And possibly multiple expansion too, that the expectation becomes growth versus contraction. Pretty exciting event yesterday. Now that we have the details, what it might lead to in coming days as it's digested and the details are disseminated. The next thing I wanted to cover from the FactSet report this week on earnings is the consensus target price for 2020 is now at 34.07, which was about a 7.5% close, 7.5% increase above the Thursday close. And I think this is really underestimating it because, number one, you have, I mean, the implication in that is that you're going to have multiple contraction. And I just don't see it because you're going from a tightening environment with no growth to a loosening environment with big growth, near double-digit growth. And we might get over that double-digit now in coming weeks with the deal signed. So it's not out of the question that this consensus target could be much higher moving forward. Next, just covered some sector expectations. The last shall be first in 2020. The worst three performing sectors, energy, industrial, and materials from 2019, are expected to have the highest earnings growth, partially obviously off of low comps. Energy at 21.3, industrials at 16.1, and materials at 13.7. The other thing that was interesting is not only did US Q4 estimates come up and 2020 stayed steady, but Euro Stoxx 600, which everyone's been so pessimistic and bearish on, they net came up. You got, 3 quarters, you average out about double-digit earnings growth. The weak one looks to be Q2 2020. But this week, they took down Q1, came in 30 basis points, but Q2 to Q4 rose a cumulative 30 bips. So basically, they took up 2020 earnings estimates for the Stoxx 600 in Europe, and that's a very, again, constructive theme going forward that's just not in the current narrative, that you could start to see some growth in Europe. And certainly what's happening in Japan will be helpful, what's happening in China will be helpful to Germany with their auto exports, etc. Moving on to our core article here of the week that we wrote on Thursday was called Crazy Rich Asians Stock Market and Sentiment Results. And this is a play on the movie. This was a 2018 movie, a romantic comedy. It chronicled a Chinese-American professor who traveled to meet her boyfriend's family and surprised to discover they're among the richest in Asia. And it was basically a long argument as to why it was in both China's and the current administration's interest to get a deal done. And it basically was a play on the theme. you could be crazy, i.e. not do a deal, or rich, agree to a win-win deal, but you couldn't be crazy and rich. And the same held true to the current administration. So that's no longer relevant. The deal got done. President Trump delivered on his campaign promise. And that's very positive. So let's move to the second theme of the article, which is the Fed. And I think this is actually, as much as the trade deal was important, I think what the Fed said on Wednesday, which wasn't covered extensively because the focus was on the British elections, which were also very constructive, and the trade deal. But what Chair Powell said on Wednesday could have astounding implications moving forward. So first and foremost, the Fed has really done its job in the last few months to provide liquidity after nearly choking off the cycle in Q4 2018. Following 2+ years of incessant rate raises and $785 billion of quantitative tightening, liquidity that they sucked out of the system, we saw the effect of that, the lagged effect of that, in the form of 3 consecutive quarters of negative year-on-year earnings growth in 2019. So that had a huge impact. And the good news is Chair Powell and the Fed realized in the nick of time, literally in the nick of time, they did invert the curve for a few minutes, but in August, but or a few weeks, but the errors of their way, and they did an about face. They did 3 immediate cuts, 75 basis point in rate cuts, and they've increased the balance sheet by over $300 billion since this summer. That's reversed almost half of the quantitative tightening program that took them 2 years to slow the economy. They've reversed that tightening into easing in just 4 months. And they've made some announcements for end of the year liquidity regarding the cash crunch and the repo. He also said something that which basically puts us on track. If they continue at this pace, we will have completely unwound the quantitative tightening program by spring. And what's so exciting about this is that for 2 years they were tightening incessantly into slowing growth. Now they're loosening into 9.7% earnings growth. So they're creating looser conditions into earnings growth, which can just be tremendously constructive. And he laid out the case as to why is he doing this. And so number one is he made a key point that he re-emphasized the concept that was misinterpreted at an earlier meeting called Midcycle Adjustment. When he first spoke those words, the market really didn't like it. But what he made the case for this week was that this is not 1998. So in 1998, the Fed cut 3 times from September to November to avert a catastrophe caused by the Russian financial crisis and long-term capital management's leveraged exposure. They were a large hedge fund that had huge exposure, and it could have created systemic risk had they not stepped in quickly, which they did. That's the good news, and the market rallied out of that trough. The bad news is they immediately took back the cuts. It's like Charlie Brown takes away the football. 7 months later, they started tightening right away in June of 1999, and by March, the market topped, and the rest is history. 80-90% crash in the NASDAQ. So what he said this week that was of greatest importance was that he said this is a mid-cycle adjustment and that we're doing nothing until 2021. So he took the idea off the table that this is 1998 and he's going to look to tighten and choke off growth too quickly again, like he did like they did in Q4. So now that that's smooth sailing and blue skies ahead, basically what his intent is, and he's talked about it many times, it's just his actions were inconsistent with his words. Now his actions are tremendously consistent with his words, and his commitment is to bring back more and more people who are still on the sidelines post-crisis back into the workforce. And he wants to bring this labor force participation rate. So look at what's happened since, the early 2000s. It's just fallen off a cliff from 67.5%, and then post-crisis it just collapsed down to 62.5%. He's saying we're going to create enough runway to get this labor force participation rate back. I don't know what he has in mind, but could you imagine if he brought it back up to 65, 66? And some people will say, well, you can't do it because you have all the baby boomers retiring. But you've got, 80 million baby boomers, but you got, 65 million Gen X right behind. But more importantly, 85 million millennials behind that, which is larger than the baby boomers. So with the right policy path, he's basically saying, I can create a mid-cycle 1995 scenario because we've got so much room to bring people back in. So yeah, full employment, 3.5% unemployment rate. But if you bring back another 3% into the workforce, it could just be fantastic. And you could do so with limited inflation because you'll increase the supply of labor as employers pay up and attract people back in. They start to offer better packages for the skilled. And what he's interested in is allowing the marginal employees back in. People that would ordinarily be rejected in a slower economy. Maybe they have a couple checkered things in their past. They're now coming back in and given a second shot and becoming productive members of society, which is just very, very exciting all around. And I just love what he laid out on Wednesday. And it's a shame that with Brexit and with the China deal, it didn't get a lot more coverage. But this is a big deal because if he's successful in his commitment to increase the labor force participation rate, let's just take a look at this BLS chart that we got through Yardeni's website, Ed Yardeni's site, yardeni.com. As you increase the labor force participation rate from depressed levels, it's going to pull up housing formation, okay, and total housing formation. So let's say you pulled this back up to 65, you pull housing formation up, and we started to see, just with this short-term trend in the last couple of years, it started to reflect in the home building sector having a nice run in 2019. We can expect more of these positive trajectories as long as Chair Powell follows through on his prescription on Wednesday. And what was beautiful about that was not only did he say no raises until 2021, he's going to provide ample liquidity and basically unwind. And he also said he's willing to go out further on the curve. So not just to deal with the cash crunch of the repo plumbing, but he's willing to buy more and more treasuries on the short end in somewhat an effort to re-steepen the yield curve. So keep in mind what this potentially means. For most people, with the curve having inverted briefly in August, most people were looking at these three cuts in a kind of 1998 analog, and we're going to have the last hurrah. And it's still possible that that's the case. He took us out of, he reversed course, took us out of this crash in 20% crash in December of last year. We're starting to get some traction, but most people are kind of viewing it here. And what he laid out this week is, no, guys, this is what I'm committed to. Mid-cycle adjustment, where I'm going to keep the foot on the gas. I'm not going to take back the cuts right away like we did here and create this type of scenario. I'm going to keep the pedal to the metal, and I'm going to bring back another 2, 3, 4% into the labor force. And we can do so by increasing the supply of labor without massive inflation. If we get sustained inflation, then I'll have to tighten, but it's highly unlikely. And sustained would be 6 to 9 months. So again, that takes 2020 off the table. And we've shown this chart a few times with the S&P 500 and what happens after the yield curve inverts. So here's what happened in 98. You had the peak. You can't quite see it here, but we had a similar thing in 1995 where it barely inverted. It got down to the 2s and 10s inversion. So we did invert in August. In the 95 analog, and I'll post it up on the site, we came really close. We came like to here, and then we did this same type of reversal, and that extended the cycle. The difference is we actually did invert here. In 95, we got so close within basis points before they reversed it, and it didn't fully invert until 98, and that was kind of the end of the cycle. And then here in late 2005, early 2006, when we inverted end of cycle. So, we just have to watch the data as it comes in. If he does what he says and he keeps the pedal to the metal, maybe that inversion will be less relevant, or it will be treated more like that near miss in 95, where they kind of pulled the plane up off the runway and took off again. So that was the most, I think that was even more important than what happened on Friday, although having seen the details of the deal now, Friday was extremely important. But what Powell did on Wednesday, and he laid out his plan, which is basically this formula, and you can read it in the article. Increased labor force participation rate yields increased household formation, yields many more years left in the cycle. So the deal is done. Powell's on the right track, and the Fed are on the right track. Here we covered just some short-term sentiment things. Bullishness came up a little bit this week. It wasn't confirmed by the Fear and Greed Index. And equity managers are still dramatically underweight. So they finished the week at 77.80% equity exposure. They're going to have to do a little chasing here. So in September, we put out an article, September 5th, about, everyone was just panicking into bonds. Pessimism was at a tremendous high, and we were pitching equities. And you can read this September 5th article, AII Sentiment. You can find them. You can click here on Sentiment to see everything we've said on a weekly basis, or search by title here. And since that call for a melt up, when people were saying, year-end melt up, we're saying that that's bananas. We've rallied 12.1% off the bottom. Just had a kind of monster move here off the bottom. So with managers underweight, there's potentially a little more juice here in certainly in coming weeks and in coming months as all these things play out. That doesn't preclude short-term normal volatility, but things are really lining up, and I think, as important as the China deal was, and much better than expected, the path that Chair Powell laid out on Wednesday is going to be paramount to that. What we also talked about after going through these short-term indicators was that a lot of stocks, since we put out that melt-up article in September, are up 50, 60, 70%, some even more. And we talked about in the last week, how do you deal with a market that's up, that may even go higher? And the antidote was to start to trim some of the winners and reallocate into sectors and stocks that haven't yet participated or are just starting to participate, like energy. And we've done a lot of stuff in the last 2 weeks on energy. If you want to review that, you can take a look at this was our September call on biotech. You can review that. But these articles on energy will give you the thesis. Basically, we're trading down to great financial crisis lows, the oil depression of 2016 lows now. The difference is earnings power inclusive of 2020 is up 55% relative to 2009 for the top 30 weights. And here, WTI was 36 a barrel. Here, it was 26 a barrel. Right now, we're knocking on $60 a barrel. So the fear in the market, which we went into in depth last week in the Taylor Swift Bad Blood energy market, that one is our most comprehensive piece on energy. If you have an interest in the sector and want to get exposure and maybe have missed this rally off the bottom, where can you still find value? We go into granular detail how to think about it. And what is feared in the market today is the leveraged balance sheets. And I say that's exactly what should be embraced. Because if you look at it, you want to look at it like a basket of junk bonds. This is how Michael Milken changed the world in the 80s. He basically said to portfolio managers, look, you've got a portfolio of investment grade yielding 7%. I've got a portfolio of junk yielding 15%. in a recession, 15% of my companies could bankrupt, but net after they bankrupt and what you recover as it's in a senior position in liquidation, plus the yield on the 85 to 90% that don't bankrupt, your net yield is going to be, call it 12.5% after the default, after the worst case defaults relative to your investment grade at 7 or 8%. The risky bonds are a safer bet if you buy it in a basket. And that's how I lay out, we can think about exploration and production names. What everyone fears is default. So let's assume the worst, 10 to 15% default. Let's say 15% just wipe out. The other 85%, and I go through the different recoveries over the last 20, 30 years, will be up 100 to 200% over the next 3 to 5 years. So patient investors are going to be rewarded even if that fear comes to pass of 15% defaulting, which it may in effect be less than anticipated because most of the break-evens are well below 50% with the $50 a barrel with the technology, and with a lot of factors in place, including Aramco's low float IPO. You can go some of the reasons why oil has a likelihood to stay, well above 50 for some time, and maybe even creep higher over time. The rig count down year on year, the financing situation, the capital discipline that's being required of these E&P producers. And then finally, there was an article in the Financial Times this past weekend that Jessica Ablin did, which was phenomenal. It covers a lot of the points that we did. She asked me for a few quotes, so you can check that out as well. So that is the core of the week. I want to cover a few other things before we wrap up. We saw in the theme of buying the out of favor value, we saw a decent amount of insider buying in some of the marginal players like Chesapeake and also unusual option activity. So Chesapeake, you saw a bunch. Occidental Petroleum, you saw a bunch of insider buying as well. And then we covered healthcare earnings. We do sector earnings, the top 30 weights. You try to do 2 sectors a week. Healthcare, the top 30 weights are showing the earnings power. 2019 earnings power was actually taken up to 2.2% in the last 60 days. But for 2020, the sector's top 30 weights are looking at 8.13% earnings growth for 2020. So that's solid. You can look at that on the site. And then we also did financials. And financials, these top 30 weights are looking at 7.06% earnings growth in 2020. That could change with the yield curve if he continues to hold down the short end and moves out a little bit, maybe up as far as the 2-year and steepens the curve a little bit. That could be further upside. Lastly, Regeneron was upgraded to Credit Suisse's top pick of the year. That goes back to our September article when we called for a move in biotech, when there was all the noise about Elizabeth Warren was leading in the polls and drug pricing and Medicare for all. The estimates were going up materially about 10%, while price was collapsing about 10%, and that's been a huge run. And now that it's up huge, Credit Suisse sees even better things for Regeneron and the index as a whole. So that's basically it. I did want to emphasize the granularity of the deal. I hope that came across well. If not, you can pull the article off the site. And that's on today's top 20 reads for Saturday. And I really wanted to go into Chair Powell's plan that he laid out on Wednesday, which I think was just so important and was undercovered. If he can pull off what he thinks he can with the right policy path, he could legitimately have a shot at 95 versus 98. The yield curve did invert, so we've got to watch the data as it comes in and not assume that that's a foregone conclusion, but be open to the possibility that good things can continue to happen, and be vigilant if the data doesn't support it. But I think with these 2 major catalysts this week, the China deal being much better than expected and Chair Powell's clear communication and path forward, we could see more and more constructive outcomes. So hope that helps. Have a great week. We'll see you back here next week.